Today, John and I are going to be talking about the 6 reasons why real estate is the safest investment during uncertain times. The problem is, in uncertain times, most investors turn to cash, bonds, or the stock market without even realizing that the most reliable protection is found in hard, tangible, income producing assets. In this episode, John and I are going to explore why investing in real estate can be one of the safest investments during turbulent times if you do it right. Now, if you're looking to make 20% annual returns and looking to invest into real estate, but don't have a lot of time, but you do love real estate and you like cash flowing assets, go to fulloutinvesting.com and find out more about our 10-step investing process. We also have a sample deal there as well that you can check out. Hey, John, it's great to be here with you.
Great to be here, Mark. I think about Andrew Carnegie, right? He said 90% of millionaires got that way investing in real estate. And I think it's an asset class that is often overlooked. Even in great market times where the stock market's booming, it's still an investment every investor should be considering for their portfolio. But in times of uncertainty, man, and we'll get more into this, but the way the cost of real estate, particularly multifamily real estate, rents and the property values rise alongside inflation, right? So that hedge against inflation, because not only are we getting that appreciation, but through our value add plan, we're forcing appreciation through increasing rents. So really excited to dive into this topic. It's an area, I've shared with you, Mark. I have some regret over not investing enough in real estate, over the years. It's something I really dove more into about 8, 9 years ago. And I wish I'd gotten into it in my 20s. I look back on some of the market cycles I missed, man, and there's a little bit of regret there. So I'm all in today, but excited for today's topic.
Yeah. And John, I just want to preface this conversation as well that cash and having oxygen in the tank, we'll say, is not a bad approach. The problem is, though, if you keep too much cash on the sidelines for too long, your returns just get eaten. It's actually eroding because inflation is eating away its purchasing power.
That's right.
And so this is where I think that the key with real estate when you're buying it is that you're buying it for long term. And so buying for cash flow, as in how much money is putting back in your pocket at the end of the day, is the key strategy to use in a downturn. Because, for example, if you're buying a property and there's no cash flow, as in maybe you're developing a new property and let's just say material costs double, well, you're going to need to keep feeding the deal. Like you got to get that money from somewhere. But if you're buying a property that's making money and is cash flowing for you, and you do a good job at operating that property even in a downturn, that cash flow can continue to keep not only paying for that asset, but can keep putting money in your pocket day after day after day. And the good news is you're going to be riding that market along. So as it comes back, not only are you making cash flow during that whole period, but you are going to do exceptionally well on the upside. And so, John, going back to what Andrew Carnegie said about, the 90% of millionaires use real estate, is that it's also the number one regret that most investors have is they wish they would have bought more real estate. Like, John, I've heard that. If I had a dime for every time I've heard that, I wouldn't need to sell any more real estate. So, and so the key here is that cash has a place. Cash has a place in the economy. If you look at all the large companies, I mean, they have huge amount of cash reserves. But the reason they have that is if let's just say their product goes down, that they have reserves sitting there. And because if they don't, their business goes out of business, right? If they run out of cash. But when you're investing, if you're thinking about investing for cash flow, as in how much does this asset put money back in my pocket, that is a much, much safer play in a downturn than buying, say, new development or buying an asset that is not stabilized and that you have to feed, as in take money out of your pocket and put in. That's how operators get into problems. And so we're going to talk about our 3 golden rules. I'm sure we're going to be talking about here today, John, because we're always talking about that, from how to protect the downside. But if you're buying properties that are putting money in your pocket each and every month, that is the play that you want to do. And if you do that during uncertain times, you're not only going to be able to have money coming back in your pocket, but you're going to have that, we'll say, the better sleep at the end of the day, not having to worry about, I need to feed this deal like most other operators are going through.
That's right. And the reality is volatility is sort of the norm right now, right? I think we have so much disruption going on with technology. I mean, we're just starting to scratch the surface on the AI. Just imagine where we'll be in 10 more years. The interest rate environment, we've got the demographic inversion that's taking place around the world. In other words, there's fewer people in the most recent two generations behind the baby boomers. So, that means less investable cash in the future, less consumers in the future. And so for us, we like investing in core human needs, and housing and shelter is the top of the list as a core human need, right? People want that roof over their head at the end of the day. When you look at the trajectory of rents in the United States, the only time rents have meaningfully dropped in the United States across the board was during the Great Depression. Even during the Great Recession, rents flattened out for 1 year and started rising again. So that core human need is what we're investing in when we're investing in apartments. But gosh, you just went through an election in Canada. We went through an election in the
Mm.
U.S. 6, 7 months ago. New political parties coming in, and just all that uncertainty. The reality, though, is hard assets weather the storm, and they create that long-term wealth through the storm, which is why we love multifamily real estate specifically. I just kind of touched on the main thing, right? It's that core human need. People always will need that place to live. Even in a downturn, if a renter decides or resident decides to downsize, they're going to still rent, right? And so when we invest, we like those Class C, Class B buildings that through our renovation plan, we bump up a class level, but we're kind of in that middle range rent. So we're not the highest rent in the area, we're not the lowest. So somebody who wants to downsize will downsize into one of our units, but somebody who's still making that good income will stay put. And, part of that resident experience we're so big on, keeps residents there long term. Because by the way, renewals are your biggest friend. If you can kind of renew and get your incremental rent increases and keep your occupancy high, that helps protect that cash flow you just touched on. So I would say, real estate in general is always a great place to invest, whether it's a single family rental. I'm a little, I would say for me personally, Mark, I'm watching short term rentals. I think we're going to see some vacation markets see some volatility over the next few years with so
Mhm.
many people buying Airbnbs the last few years. And I think the economic climate, maybe people are taking fewer vacations, but at the end of the day, office, retail, and industrial all offer opportunities. But man, multifamily is just the most resilient because it goes back to that core
Mhm.
human.
Yeah, that's right. And that's where the operations side becomes really important. If you have really great operations, you're going to be able to have an advantage and have your building an advantage over the competition as well. So that's not even included here. I'm lumping that in. It's a basic human need. So operations is a big part of that. I'm going to add that out of that as a bonus at that point. But when you have all these large companies moving into these affordable cities, like say Atlanta, Charleston, Tampa, for example, these people need a place to live. And that's a fact. They need a place to live. And most people they'll rent first versus going, I'm going to go buy a house, especially if there's a new factory that comes into town. And so that we're getting ahead, especially now with, made in America right now. That's a really big push. And so today's market, if you're looking at, okay, it's a human need, and we know that there's going to be more manufacturing, there's going to be more jobs that are brought into the US right now, then actually investing in these affordable cities today is actually getting ahead of the turn, so to speak, of these large companies coming in. And we're going to be positioned extremely well with that, knowing that it's a core human need. People that are working in these new jobs that are coming, they're going to need a place to go. So that's the first one, is that it's a basic human need. The next is tangible real world value, as in you can go and touch it, you can
Yeah,
feel it, you can't manipulate it. So interest rates can be manipulated, I guess, in some form of fashion. But the reality is when we're buying, say, 100-unit apartment building, you can go and touch it and feel it. When you're putting your down payment on, that's real. You can
yeah,
you can go and say, okay, this is not going to be manipulated. This is not just, it's going to vanish into thin air. And that's one of the biggest things that I like about this, is that no matter what, it's always going to be worth something.
that's right.
And so the beauty with these assets we're buying, John, is that you can't replace it with new build anywhere close to the cost that we're buying it for. We're
Yes,
buying these well below replacement value. And so whenever you're doing that, that's why we like the B class space versus like that A class space, that the cost per per unit is quite a bit higher. We're buying it at such a significant discount, and we're buying them knowing that we can actually go in and improve and renovate it, and we can verify that we can get those rents by looking at all the comparable apartments in around the area. This to me is a very simple approach to be able to make money, and it's proven itself over decades. And this is where the wealthiest that we've seen, they invest into real estate. And generally what I see, John, through the years is that a lot of investors, as they graduate, they start in single family, and then they start to get into some smaller multifamily, and kind of we'll call them the crown jewel of real estate investing are these 100-unit apartment buildings. And so there's a reason for that as well. But being that it's a real world tangible value that's actually producing cash flow and it's spitting out more income than all of your expenses, that's a real value add in a recessionary downturn market.
Yeah, and you use the word manipulation, which, I think about stocks and crypto, right? And there was an example recently, just a few weeks ago, actually, when the tariffs were first announced, now, kind of since been rolled back or lessened. A very, followed, astute investor, I won't say his name, but went on Twitter, X, I guess, and said, that Hertz rental car fleet was now worth $1.2 billion because of these tariffs, because, used car values will go up alongside the cost of a new car. And that X or whatever they call it when you now, tweet on X, whatever they call that, resulted in the stock value of Hertz going up by 100%. Now, what that investor failed to mention is that, you know, Hertz isn't planning to sell their entire rental car fleet, number one. Number two, they often have to because, the cars get worn out or, they need to bring it. So they're going to have to buy new cars eventually as well. And on top of that, tourism is actually down a little bit. So Hertz rental car, fleet isn't being as well used. But based on that one tweet, a lot of emotional investors went in and invested. Now, when I say manipulation, I don't think this investor, and maybe he was, maybe he wasn't invested in Hertz. I don't know that. Why he tweeted that and didn't include the other data, I don't know. But, that stock just goes up 100% in value. Now, that was great for Hertz investors at that moment, but you go look at a couple weeks later and it kind of normalizes again. And it's just wild to me that just a tweet can create that much volatility in a stock. And so another factor to consider is so many stocks are now traded through index funds and EFTs that what's starting to happen is these, big index funds trade at such volumes that the valuations of the individual stocks are very divorced from the reality of the financials of the
Yeah.
company, because these decisions aren't being made on an individual stock basis. They're being made at a, sort of this macro level where, like, oh, we're going to sell $1 billion of, our index fund, and they just go through and they make decisions on these individual stocks. And so, it's not to say don't invest in the stock market. I'm heavily invested in the stock market. I think about my investments in the stock market as my retirement. I think about my investments in real estate as my wealth creation. And so we're not sitting here telling you not to invest. It's about having a diversified portfolio. You should own stocks, you should own some bonds, you should own real estate, and some other alternative investments that catch your attention, depending on your wealth, maybe some startups or investing directly in private businesses. But it's about that diversification. So if you're all invested in the stock market, you should be considering adding real estate in, simply for that risk diversification that every investor should be putting into their
Mhm.
portfolio. But it's not about emotion. It's not about a tweet. At the end of the day, the stock market could crash, but these assets will still be valuable. And I think at the end of the day, that's why we love them.
Yeah. I'm when it comes to real estate, I'm having a larger percentage of my wealth into real estate. Is that's more my thesis, is like real estate is the game. Where I've really gone more all in on, John, is the fact that I'm less about appreciation and more about cash flow. Appreciation's still there, but the cash flow side of it, as I've gone through a couple of cycles, I've become more hardcore on, okay, how much cash flow does this put in my pocket?
That's
And
right.
how much upside can I force by doing renovations?
Mhm.
This mindset has shifted a lot because, in the past, like when we were buying properties from, 2008, 9, 10, like it was appreciating, and, it was cash flowing a little bit, the assets that we were buying. And it was great. That appreciation was like, it created a lot of wealth. but I was never really focused on the cash flow side of it. And then you start to go through a couple of cycles there and you see, okay, pricing starting to come down. Some deals maybe aren't cash flowing as well. It's like, wait a sec, like cash flow becomes the most resilient and recession resistant approach. And this is where Robert Kiyosaki, through the years, he's like, buy for cash flow, buy for cash flow. I was like, oh, okay, that makes a lot more sense to me. Buy for cash flow, because in any sort of downturn, even if the pricing drops and you can still make money, you can still cash flow. Because what's interesting is when you see pricing drop, that doesn't necessarily mean that your rents are going to be dropping that much as well. Like a lot of times rents can stabilize and even out, and then pricing has come down. But if you've locked in your rates and you have some extra cash reserves there at the property level, and you're cash flowing, most times that property will still carry itself, and you'll still be able to get cash flow coming out at the end of the day. So again, that's where for me the cash flow game has been really important, John. That's why I like these deals so much, is because not only do they have mass amount of upside, but I mean these are cash flowing 5, 6, 7% on an annual basis. And this reminds me back from when I first started back in 2008 and 9, started in investing in properties. It's got this, they have the same fundamentals, it's just at a much larger scale.
100%. And, it's nice getting those checks in the mail
Yeah.
on a clear quarterly basis,
Yeah.
right?
Well, for the Canadians too, they that have the US income coming in each and every month. Like that's one of the biggest things our investors. Hey, Mark, I love seeing the US dollar come in. If you're in the US, it's like, yeah, of course I get US dollars. It's not a big deal. But
Right.
the trade, I think it's at 139. So for every one US dollar, that it takes $1.39 Canadian to buy one US dollar. So if you're getting US dollars on a monthly basis in cash flow coming into your bank account, uh, it's a beautiful thing. And the way we structure deals too, as you know, John, it's return of capital. So there's no sort of taxes at the end of the year, not until we sell the asset in 3 to 5 years as well. So that sure is a very nice thing, that not only is it carrying itself, but you're getting extra cash flow along the way, which becomes the main focus. And in my perspective, anyways, that's more my thesis today than it was 10 years ago.
That's right. Another big reason we touched on a little bit earlier is that hedge against inflation. So as inflation rises, so do rents. And hard assets tend to retain and even grow their value during inflationary periods. More investors start looking into hard assets. There's more competition for the deals. The valuations start to increase. And yes, expenses may increase, but so does income, right? So when you're taking down an apartment building and you manage it really well, like we do, with a lot of oversight and extreme, I would say, just on the edge of micromanagement, candidly, how we manage our deals, we make sure our income is also increasing. So, just that hedge against inflation is so huge because, as you said, if that money's just parked in a savings account somewhere, look, I like to keep a little money in a savings account. You never know when a car might break down or you have an emergency expense. So I'm a firm believer in having a little cash on the sidelines, but as that money sits in that account, it's losing value every day to inflation, right? So you don't want to have all your money parked in cash, right? It's just enough for the rainy day, but you want to have your money working for you while you sleep. And I think that's one of the big reasons. It goes back to that cash flow, right? You're making money when you're not even working. So
Yeah.
love
So,
that.
John, I'm going to just quickly dive into this inflation a little deeper there for the listeners. So, back at the peak over the last year or two, inflation actually got up to, I think it was a couple of years, 2 to 3 years. I'd have to double check, but it actually got up to about 8% inflation. So, what does that mean? That means that if you have $100,000 in the bank, that means that at the end of that 1 year, that 100,000 you still have in the bank account, but it only buys $92,000 approximately worth of goods and services. Okay.
Yes.
That's what inflation does. It means that as they print more money, it means that there's more, we'll say, currency, there's more dollars that are out in the market, which waters down the value of those dollars. Another way to look at it is if you go and get a quote for your pool in your backyard, and you get a quote for a pool and it's $100,000, and it's very easy to spend that in today's market. Um, that pool 1 year later, if you get a quote, will be worth. They're going to quote you $108,000. That's what happens, and so you can see it in the grocery store today. It's like all products have gone up in pricing, and so cars, and it goes back, many years of, like, was it like 50 years, you could go buy a candy bar or a, chocolate bar for, probably 25 cents or whatever, and now you're paying, a few bucks, and so everything goes up in value. So that is what inflation is. And so the power in multifamily investing and buying apartments is that if the dollar's value goes down, that means that rents will pace that currency debasing, and so your rent, say if you're charging $1,500 on average, you can actually go in and raise rents to match inflation. And if you track rents and inflation through the years, you'll see there's a correlation with what that is. So it actually paces that. Now, the caveat to this is if you are investing in an area where there's rent control, you can only raise rents based on the amount that the board, the landlord tenant board, will allow you to. So, for example, in Ontario, we have a number of assets, so just north of Toronto, and they only allowed this year 2.5% per year in rental increase. Back when inflation was 8%, they had a freeze on how much you could raise your rents. And so there's 8%. And so we're losing on that. And so the
Yes.
problem is, if you're investing in these areas, and this is one of the biggest reasons why we started Faris Capital, is because there are many markets out there that if you go and invest in your backyard, they have rent control and you can't raise rents to market value. So this whole idea of buying rental property to hedge inflation, well, it doesn't match up. It doesn't match up because there's restrictions on how much you can raise rents. These markets where John and I and Fair's Capital that we're investing into, that our investors are coming in and partnering with us on, we're able to go in and buy these assets and raise it to market value. Even with inflation there, we can raise it because there's no restrictions on the amount that we can raise these rents to. Now, the good news with that is that the market will dictate to us how much we can raise it, as in we can go in and provide exceptional value when we take a new asset. We can go in and add a lot of value, and we can actually charge more. And if the residents agree with that, then everything works out. But there's no third party or government uh, policy that's telling us that we can't do that in these markets. And so, John, I wanted to kind of dive into that a little bit more, because inflation, I know a lot of times, back a number of years ago, I hear this word inflation, but it was not until I started digging into it did I truly understand how it affects the dollars that you have, and how real estate, investing in the right areas, can be a massive hedge against that. We'll call that a hidden tax that's out there.
That's right. Oh gosh, I'm so glad you went deeper there because you're dead on. I mean, if you can only raise your rent 2.5%, inflation is 4, you're losing money every year.
Yeah.
But gosh, when they freeze it during 8% inflationary times, so those markets in the U.S. with no rent control are really the only markets we consider for that reason. And it's not about squeezing residents out as much rent as possible. It's like we're providing the value. We're renovating these buildings. We're adding amenities. We're adding better service. Our properties,
Yeah.
we have all these guarantees around how quickly we get maintenance items taken care of. So we're providing a better experience. And, candidly, we should be, in a sense, compensated for that, right? Better quality unit, better quality service, better amenities, and residents are willing to pay that. So, yeah, I'm so glad you dove deeper in there because it's such a key factor. 100%. For me too, one of the things that you and I talk a lot about, and we sort of touched on this, the idea you can actually go see and feel and touch these buildings and improve the operations. But it really, that's what it boils down to, right, Mark? It's we have control here. If there's some new information, a new building comes in down the street and it's impacting us, we can look into our, toolbox and decide, well, what service should we add or how can we better compete with this? And so we're not at the whims of, once again, a tweet or a political decision that gets made in Washington that impacts the value of a stock that I happen to be invested in. We can raise rents. We can look for ways to reduce expenses. Now, we touched on this a little bit earlier, but right now, when it comes to things like, your materials costs, we're actually seeing those costs rise. So, we're always putting a contingency budget. You mentioned the gold rules. One of them you could probably guess as you're listening to this is we only buy cash flowing deals from day one, right? Because we talked about cash flow a lot. The other is we always have strong reserves. So whenever we're raising money for a deal, we always put reserves in place for our, contingency for our renovation plan, as well as for our mortgage and principal and interest payments just for a rainy day. But we can reduce expenses in other ways. So we've seen situations where maybe when we buy the building, it's in our mind overstaffed, and maybe we think we can run a little bit more lean. Sometimes through economies of scale, we own multiple buildings in an area so we can share resources across those buildings. So, for example, when we recently closed on a 36 unit townhome building in Charleston that sat just between two other complexes we own, we could share some marketing expenses and we could share some labor expenses across those deals. So we're able to lower those expenses through creativity and other ways where once again, it's not some political decision gets made that we have no control over. Um, just down to the service, right? Just making sure we hire really great property managers and leasing managers that return people's phone call promptly, that are in the office. Mark, how many times have we tried to tour rent comps and it's like a Tuesday at like 2 in the afternoon and nobody's in the leasing center? There's just a sign on the door that says, if you need me, call this cell phone number or whatever. Like, you're not going to find that at Faris, residences. Our staff is in office and available. So if there's a leaky faucet, a toilet that's overflowing, or anything that a resident needs, we're there for them. And so by doing that, once again, we're willing to pay for that. It's service. Um, Ritz Carlton exists right next to a Holiday Inn. Why? Because of better service and better offerings, right? And that's what we're doing here. So that level of control really allows us to protect the value and drive the returns, even if the broader economy is slowing down for one reason or another.
That's right. So we got so far we got human needs. That's a human need, tangible, real world income producing asset. We have inflation hedge. We got control over the asset. We have consistent cash flow. You just talked
Yeah.
about
Yep.
as well. And so we start those distributions about 3 months after we close on a deal, and then we do a catch up, and then it's monthly after that. So monthly distributions, monthly cash flow, which John is beautiful.
I love
You
it.
don't need to do
Mailbox.
anything. There's no late night tenant headaches, toilets, come and fix me, come and fix me. It's like, and the power in that, as well as the structure of how we structure this, as well as that the returns cash flow that comes into our investors, is that it's return of capital. So that at the end of the year, there's no sort of tax consequence, not until we sell the asset. It does it count as a capital gain at that point, which is the most preferred kind of tax that you want to pay. So it is very, very beneficial as well. And there's less volatility with that. You can see stocks going up and down, but our distributions, we've hit everyone that's been under the Fair's capital flag from start to finish. We've hit every single distribution, and it's just consistent. And so there's a lower volatility when it comes to this compared to stock down, 10% one day, and then it's up 5, and then it's down another 15, and you're feeling really bad, like, oh, I just lost $100,000. Is like, John, like, not having to look at your stocks every day and worrying about it, even though you're like, I know it's a long game anyways, but you still feel it. You still feel
I
it. It's
got
like, honey,
that.
this wasn't a good day today. She's like, how much did we lose? Like, the talk at the dinner table is not that great. It's like,
Yeah.
we lost
Yeah.
$100,000, honey. Is like, I don't think that there's going to be a romantic evening that night, John, after the 100,000 lost conversation, right?
Oh my god, it's so funny because I'm generally pretty good at not looking at
Yeah,
my retirement accounts and my investment accounts, but it was a little hard not to the last few months, and it's like a roller coaster ride,
yeah,
man. Like, I mean, I lost like a big number in one day, like, I mean, enough to give you like heartburn for a couple of months, but then it was like down again and up again, up again. And it's like, here I am 3 months later, whenever the tariff talk started, and I'm back to par, where we started 3 months ago. So I finally decided, what, I'm just going to delete the app from my phone.
yeah. That's
I
probably
have to
good.
be a little
Yeah.
more intentional to go log in on my computer. So I'm just like not going to look as much. And I have a fantastic financial planner, and she thanks me for not being too spazzy. But I had to call her a couple times, be like, am I because candidly, I called her before all the turmoil and I was like, I have a feeling it's going to get a little rocky. And she said, just ride the wave, man. Just don't sell. That's what amateur investors do. But it's still hard not to second guess yourself when, a big number disappears over one night. But Yeah, I think you sort of touched on this, Mark, but the last point I think that is really worth talking about is just it's these deals are treated favorably by the tax authorities right
Yeah.
now. In Canada, you get a little less tax benefit than you do in the US, but you get depreciation. You mentioned those distributions are return of capital. So, there's no taxation at the end of the year. Once we close the deal, then that capital gain is recognized and you pay at that time, but you get that tax-free cash flow coming back into you on a daily basis. In the US, we have cost segregation where we can actually separate out the value of the personal property, which, if you're a realtor listening to this and you do residential, you think about personal property as being anything that's not affixed, where in commercial, actually things that are affixed can be considered personal. So the cabinets, the flooring, the countertops, and things like that. And so very favorable tax treatment in the US, but great favorable tax treatment in Canada as well, just a little bit more in the US. And so, if there's a down year, in the stock market, those losses, your passive, whatever, those can be offset by some of that, depreciation and things that you get in terms of your real estate income. So, to me, it's just once again, every accredited investor out there should be considering real estate as part of their portfolio. Bottom line, it's just prudent to diversify at the end of the day.
Yeah, 100%. So just realize, when you are, say, you have your money in, say, cash or bonds or stocks, for example, from a safety standpoint, there's risk in every single class. I mean, with cash, you have inflation risk. With bonds, there's still fluctuations that happens with that as well. And, at the end of the day, I mean, bonds, it's a government promise. And so, I mean, there's people saying, well, what happens with the government? What happens with that if something goes sideways there? And so there's risk with that. And then stocks, I mean, we talked about that as well, John. There's ups and downs with that at the end of the day. And also the fact that you could be totally swayed by a tweet, like you had given the example earlier. And so, understanding that there's risk in anything that you invest into. And this is where, at the end of the day, where we've settled on and where we've seen some of the wealthiest investors in the world is buying tangible assets that are income producing is a huge safety measure to be able to invest into for long-term growth and passive income as well, moving forward.
Yeah, yeah. So just some, key insights, right? So hard assets hold value, that cash flow, tax protection, as well as operational control. Now, as a passive limited partner investor, you're ceding some of that control to us. So at the end of the day, if you're thinking about investing in as a limited partner, do a lot of due diligence on the general partner, the operator, and make sure that you're comfortable with their business plan. They answer all your questions and are totally transparent about the good, the bad, and the ugly about the deal. All deal have a certain amount of risk associated with it.
Mm,
So anybody who tells you there's no risk, run for the hills. But have those conversations, and when you find a solid general partner operator that you trust, bottom line is ensure, like we do at Ferris Capital Partners, that it's totally transparent. So, for example, we
mm,
send out a monthly update on the 30th of every month, 28th in February. And if we miss that, we owe you and your family a steak dinner. We say that with a little bit of a smile on our face, but at the end of the day, if we miss that on one of our deals, it's like a ten to $15,000 mistake on our part. So you better believe we get that out on time every single month. And we include everything that's happening at the property, lease trade out. So you can actually see the impact of, we took this unit, we renovated it. Here's what the rent was before. Here's what it's after.
mm,
Here's the potential value created that at our exit cap rate. We post reviews that we've received, good news as well as challenges or bad news. Sometimes things happen. We had an irrigation system fail at one of our properties. So we talked through how we handled that and how that could have potentially impacted things. In that case, because we had those strong reserves, it was not a big event, but we're just very transparent. So that control is important. And then in uncertain time, tangible income producing assets aren't just smart, they're essential to your portfolio.
Yeah, John, that transparency I think is really important when it comes down to investing. And what was one of the main reasons why we actually started this show was to be able to give investors an opportunity to see behind the we'll say the curtain, so to speak, on how we're operating these deals. And I think that's where, when you're assessing any sort of investment, my thesis is has got to be in perspective. This is my opinion, is that it should be simple enough for you to understand. This is Warren Buffett's advice: is don't do anything that is not simple enough to understand. And so this is why he didn't get into the whole, the internet boom back a number of years ago in crypto. And he's like, I just don't understand it. And so that's where our mission here and why we've created this show, a big part of it is to really give you an understanding in how these deals work, how simple they are. It's not easy, but it's very straightforward and simple, that if we can go in, we can find an underperforming real apartment building that you can go and touch and feel, and we can shop the comparable apartments, and we can verify that if we go in and renovate and dust and shine and polish, we can actually get higher rents. And if we operate it and do a good job building the culture in that community, that we can actually force appreciation, because these buildings are based on how much income. So we can increase the income that these apartments generate, and we can get these returns based on, we'll say, very conservative projections, and increases in value. And so it's got to be simple enough for you to understand. And so that's where, keep listening to these shows, because gives you a really good understanding of how we approach things, how we deal with our deals, and how we're confident in our delivery, and how we're overshooting our projected rent projections in our deals that we're getting now, because we're doing all these extra things. So anytime you're assessing a deal, take a look. And if you do want to learn more about how we're doing these deals, and a little bit more about what a sample deal would actually look like, go to fulloutinvesting.com. We actually have our 10-step full out investing process there that you can follow along to truly understand more about how we take a deal from start to finish. And then there's a sample deal there as well moving forward. Go to fulloutinvesting.com. Thanks for listening. If you enjoyed the show, please subscribe and share it with other high net worth investors that you think will benefit from it. Thanks for tuning in to the Multifamily Investor Playbook. We love and believe in you guys. Keep dreaming and investing big.